In 2019, WeWork was the most valuable private startup in the world. Investors poured billions into a vision of elevating the world's consciousness through communal office spaces. But beneath the beanbags and free kombucha, a catastrophic financial flaw was hiding in plain sight. The story of WeWork is a masterclass in how narrative can completely detach from reality. It's a cautionary tale about the dangers of unchecked hype, charismatic founders, and a business model that was fundamentally built on sand. This isn't just a story about a bad office rental company. This is about the mechanics of a modern financial fraud, enabled by some of the smartest investors on the planet. To understand the collapse, we have to go back to the beginning. Founded in 2010, WeWork started as Green Desk, a simple co-working space. But CEO Adam Neumann had a much grander vision. Neumann pitched WeWork not as a real estate company, but as a tech platform, a physical social network that would redefine community and work. This tech narrative was key. It let WeWork command a valuation that made no sense for its actual business. By 2018, WeWork's valuation had soared to $47 billion, making it worth more than established real estate giants. Its investor list read like a who's who of Silicon Valley, led by SoftBank's massive vision fund. They were betting on Neumann's vision of a future where work was fluid and community-driven. But let's look at the actual numbers. In 2018, WeWork's revenue was an impressive $1.8 billion. Sounds great, right? Except they burned through $1.9 billion to get it. That's a net loss of nearly $2 billion. This massive loss wasn't a temporary glitch. It was baked into the company's DNA. To show profitability, WeWork invented a new metric called Community-Adjusted EBITDA. It was a number that conveniently excluded all real estate costs, the single biggest expense of their business. Once you removed the fake metric, the core problem was brutally simple. WeWork's entire business model was a high-stakes gamble on a massive mismatch. The company signed long-term leases with building owners, locking in payments for years. At the same time, it offered short-term, flexible memberships to its tenants. Think about that. You are on the hook for rent for a decade and a half. Your customer can walk out in a year, or even a month. If the economy turns, if trends shift, if your customer base dries up, you're left holding a catastrophic, multi-billion-dollar bill. This wasn't a minor risk. At the time of its IPO filing, WeWork had committed to $47.2 billion in future lease obligations. That's a staggering amount of guaranteed rent, funded by revenue from tenants who had almost no obligation to stay. So how did it get this far? The answer is aggressive, relentless expansion, funded by endless capital. WeWork was opening new locations at a breakneck pace, gobbling up leases across the globe in a race to capture market share, all while burning through billions in cash. By 2019, the empire stretched to over 800 locations in more than 120 cities. It felt unstoppable. The fuel for this growth was SoftBank, which poured over $10 billion into the company. They weren't investing in a property company. They were investing in Adam Neumann's elevated vision. But all that cash was evaporating. In the first 6 months of 2019 alone, WeWork burned through $2.4 billion. The company was a money incinerator, and the only thing keeping the lights on was the next round of investor funding. The turning point came in August 2019. To raise more money, WeWork had to go public. It filed its S-1 prospectus with the SEC. This document, meant to attract investors, instead became its autopsy report. It laid bare every flaw for the world to see. The S-1 revealed the staggering losses, the made-up metrics, and the terrifying lease mismatch. It also revealed bizarre governance. CEO Adam Neumann had extracted $700 million from the company, and WeWork had even paid him $5.9 million for the rights to the word we. Suddenly the narrative shifted. Analysts and journalists started doing the math. They saw a company valued at 26 times its revenue, while traditional competitors like IWG traded at just 3 to 5 times. The tech premium evaporated overnight. The emperor had no clothes. The IPO process crumbled. Investors balked. In a last-ditch effort, the board forced Adam Neumann to resign as CEO. They imposed new rules, even requiring therapy for drug use as a condition of his continued employment. It was a spectacular fall from grace. WeWork officially postponed its IPO in September 2019. The $47 billion valuation was now a ghost. The company was bleeding cash with no path to public markets and a business model that had been thoroughly discredited. The fall was swift. A month later, SoftBank, the company's biggest champion, stepped in with a desperate $30 billion rescue package to prevent bankruptcy. But the terms were brutal. As part of the bailout, WeWork's valuation was slashed to just $8 billion. The company limped on for years, a shell of its former self. In 2021, it finally went public through a SPAC merger, listing at a $9 billion valuation, a fraction of its peak, but still a shockingly high number for a company with this history. The public markets showed no mercy. With clear financials and no more hype, investors quickly realized the fundamental flaws remained. The stock price cratered. By 2023, WeWork's market capitalization had fallen below $100 million, from $47 billion to less than a rounding error. The company warned of substantial doubt about its ability to continue. The empire built on a lie was finally and completely bankrupt. So what's the lesson here? WeWork's story is a warning about the limits of narrative. A compelling story, told by a charismatic founder, can convince even sophisticated investors to overlook basic, brutal math. Hype is not a business model. It's also a lesson about governance. When a founder has unchecked control, when red flags are ignored in the pursuit of growth, disaster is inevitable. The $700 million cash out and the trademark fee were symptoms of a much deeper rot. Ultimately, WeWork confused being popular with being profitable. It confused a community with a stable customer base. It confused long-term liabilities with short-term assets. And in the end, reality doesn't care about your vision. The math always catches up. If you found this breakdown of the WeWork collapse insightful, make sure to subscribe. We'll keep digging into the basic business stories and the hidden truths behind the headlines. Thanks for watching.